Hello and welcome. Here at My Tax Accountant, our whole mission is to make UK tax simple. Today, we're tackling a difficult subject, and that's the paperwork that follows a loss. Specifically, we're going to explain how thousands of families can actually avoid that really daunting inheritance tax form, the IHT400. So, let's get right into it.
You know, when someone passes away, the very last thing you want to be dealing with on top of all the grief is a mountain of official forms. It's an incredibly stressful, often confusing time, and, well, the weight of getting everything right for HMRC can feel pretty overwhelming.
And that right there is the crucial question. And for so many families, the answer, thankfully, is no. You see, the government recognized that the old system was causing a whole lot of unnecessary stress. It was forcing people to complete these really complex tax forms even when no tax was due. So, a few years ago, they changed the rules, and for the better. So, in this explainer, we're going to walk you through what all these changes mean. We'll start with the problem, then we'll explain the solution, this thing called the accepted estate. We'll cover exactly how an estate qualifies, the common traps you need to avoid, what the new simplified process actually looks like, and of course, how we can help.
Okay, so first things first, let's really get to grips with the problem we're trying to solve here. The IHT400, that's the full, detailed inheritance tax form. It demands a valuation of everything the person owned. I mean, its sheer complexity can cause major delays and distress, locking up access to the estate at the very moment families need it most. And that's exactly why avoiding this form is the key to a smoother, less stressful probate.
So, how do you get on that simpler path? Well, the answer is a term you need to know, the accepted estate. This is HMRC's official name for an estate that doesn't need to go through that full, complex IHT reporting process. Honestly, getting this classification is the goal for a much quicker and easier route to probate.
So what does accepted estate actually mean? Well, it's simply an estate that ticks certain boxes set out by HMRC. The key thing to understand is that the word accepted refers to the reporting requirements. It's not about whether tax is due or not. It's really just a way to streamline the whole process for the vast majority of estates that don't owe any inheritance tax anyway.
The critical date you need to remember is the 1st of January 2022. This is when the rules changed to cut through all that red tape. Before this, lots of families had to fill out a shorter but still separate form called the IHT205. But after this date, that form was scrapped entirely for deaths in the UK. The whole process just became so much more straightforward.
And here's a little did you know for you. The impact was huge. These changes were designed to remove this paperwork burden from over 90% of non-tax-paying estates. Just think about that for a second. For 9 out of 10 families who don't owe any tax, the process of reporting to HMRC has been massively simplified. That's saved untold hours of stress and work during an already incredibly difficult time.
So this brings us to the all-important question, how do you know if the estate you're dealing with actually qualifies? Well, there are 3 main routes, or categories, to becoming an accepted estate. Let's break them down, one by one.
The 3 categories are low-value estates, where the total value is below the IHT threshold, exempt estates, where pretty much everything is left to a spouse or charity, and foreign domiciliary estates. We're going to focus on the first 2 because they apply to the vast majority of people here in the UK. All right, first up, let's look at low-value estates. In simple terms, everyone has a tax-free allowance for inheritance tax called the nil rate band, which is currently £325,000. If the total gross value of the estate is below this amount, it qualifies. Now, what's really crucial is that if the deceased spouse passed away first, you can often transfer their unused allowance, which could double the threshold to £650,000. Just remember, there are also limits on any large gifts made in the last 7 years, as you can see right there.
Okay, next up we have exempt estates, and this is where a really big change happened. The limit was raised all the way up to £3 million. This applies when most of the estate is left to a surviving spouse or a charity. But, and this is a very important but, there's a second test. You have to look at what's left after you take away the gift to the spouse or charity. If there's anything left over for, say, children or other relatives, that leftover amount must still be below the standard tax-free allowance we just talked about. This is what's called the net qualifying value. Okay, so knowing the rules is the first step. The next, and just as important, is knowing the exceptions that can really catch you out. Even if an estate seems to qualify, and even if there's no tax to pay, certain situations will still mean you have to complete the full IHT400 form.
Let's run through the main pitfalls. The most common one is something called a gift with reservation of benefit. Now that sounds complex, but the example is really simple. Imagine someone gifts their house to their children, but keeps on living there without paying rent. For tax purposes, that house is still treated as part of their estate. This is a big red flag for HMRC, and it means an IHT400 is definitely required. The same goes if the estate has significant foreign assets or is over that £3 million cap.
Right, let's tackle a very common point of confusion. Lots of people have heard about the residence nil rate ban, that extra tax-free allowance you get when passing a family home to your kids or grandkids. So, if an estate is worth, say, £450,000, which is over the basic £325,000 threshold, but this extra allowance means the final tax bill is zero, surely you can avoid the IHT400, right?
And here's a professional tip for you. The answer to that question is a really clear no. This is a crucial trap to avoid. The residence nil rate ban is a relief that you have to claim on the full IHT400 form. It does not help you avoid the form in the first place. The test to be an accepted estate only looks at that basic $325,000 allowance. So if the estate's value is over that, you must fill in the IHT400, even if that extra residence allowance means there's no tax to pay in the end.
And here's another very specific trap to be aware of, this time for estates in Scotland. You see, unlike the rest of the UK, Scottish law gives children something called legal rights to a slice of their parents' assets, no matter what the will says. For the accepted estate test, HMRC has to assume these rights will be claimed. This can actually reduce the amount that officially passes to a spouse, which can push that net qualifying value over the limit and boom, unexpectedly trigger the need for a full IHT400.
So let's say you've navigated all the pitfalls and you've confirmed the estate is accepted. What happens next? What does this new, simpler process actually look like?
Well, the change made things a whole lot easier. As you can see, the old two-step process is gone. You no longer have to fill in a separate tax form like the IHT205. Instead, the key inheritance tax figures are now built directly into the main probate application. You still have to do the calculations, but you declare them all in one place.
Now these are the key values you'll need to have ready, and it is so important to get these right, so let's just walk through them nice and slow. First, you've got the values for inheritance tax. The gross IHT value is the total of everything, all the assets plus any big gifts made recently. The net IHT value is simply that gross figure minus any debts and funeral costs. Then there's that crucial net qualifying value we mentioned. That's the net IHT value minus only the exemptions for a spouse or charity. And finally, you've got the probate values, which can be different because they don't include things like joint bank accounts, which pass automatically to the survivor. The main takeaway here is this: even though the separate form is gone, your legal duty to value the estate accurately is still very much there.
Phew, we've covered a lot of ground there, from the big rule change all the way to the specific values you need to calculate. So let's bring it all together and summarize the key points you need to take away from all this. So the crucial points are these. First, the system is now much simpler for most estates where no tax is due. Second, always double-check the conditions for low-value and exempt estates really carefully. Third, be vigilant for those pitfalls, especially the residence nil rate ban trap and gifts with reservation. Fourth, please remember that simpler paperwork does not mean less responsibility. You must still get the valuation right. And finally, if you have any uncertainty at all, professional advice is the surest way to prevent mistakes and those stressful delays.
And just a quick reminder, this explainer is for general information. Tax rules can and do change, and every family situation is unique, so this is absolutely not a substitute for professional advice that's tailored to your specific circumstances.
Look, navigating all these rules can save a massive amount of time and stress, but it's so vital to be certain that you qualify. If you're feeling overwhelmed, or you just want the peace of mind that comes from getting it right, please do contact us at My Tax Accountant. We are here to help. You can call us on 020-8570-8531, or you can email us at info@mytaxaccountant.co.uk. And for more clear tax explainers just like this one, please subscribe to our channel. Thanks so much for watching.